Hello, good afternoon. You're watching Closing Trades on ET Now. I'm Anisha Jain. With me is Ajay Sharma. And the closing trades are not turning favorable for bulls at all. It's a day of inherent weakness for the market. We started off on the back foot, and since then, the weakness has just been getting worse. In fact, it's the biggest intraday decline that we have seen since January of this year. So very, very palpable as far as the decline is concerned. Almost 300 points shaved off the Nifty. But we are not alone in this fall. If you look at the Asian markets, they are down anywhere between 2 to 3%. Hang Seng, for instance, was down. Nikkei was down. And the European markets too have opened on the back foot. There's a cut of 1.5% across the board. And all of this is because of that US downgrade coming in from Fitch. And that has put the spanner at work because the futures for US are also suggesting a downtick of anywhere between 1 to 2%. India VIX has seen a sharp spike. It's up in double digits, almost at 12-13%. Spike coming in as well as India VIX is concerned, and all the sectors are in the red. The advanced decline ratio is unfavorable, so no green light at all, Ajay, at this point of time to watch out for, because every time we are trying to see a bit of a recovery, it's getting sold into.
I would rather say look at the other side, Anisha, that closing trades are actually turning out to be extremely profitable. For viewers who listen to ET Now and of course ET Now Sadesh, we have been talking about how the light at the end actually is turning amber. We have actually been telling you that the US dollar index has been above 102 for some days now. Bond yields were rallying very sharply to above the 4% mark, and US markets, most of the triggers had played out. Back home in India too, 2/3 of the earnings are over. Most are either in line, slightly on the lower side. So there was clearly lack of fresh triggers. We may debate, or we'll in fact dissect it for you, whether the rating downgrade by Fitch in US actually merits this kind of a fall in global markets, Europe or India or not. But just by the sheer nature of the rally we actually saw in US markets, India as well, even the slightest kind of a prick may have triggered some amount of unwinding of that. Not correlating whether it actually spells disaster for global markets or US in particular. In fact, I must tell you, today, Bank of America, being one of the first global banks which have come out and said that US economy is actually doing very well, and they have officially reversed their call to a no recession call. Earlier, they believed that US economy would be heading to a recession, but now they've reversed their call. In fact, they want to say that the commentary coming from US Fed as well last week was actually showing US economy in a very good state. Not to mention the US Q2 GDP, which came in way ahead. So whether this correction or a kind of a softish move, which we are seeing a trending day lower, directly financial markets are sometimes more impacted by sentiment rather than direct financial implication. In fact, I was just telling Anisha earlier that Goldman Sachs today overnight put out a note saying that this Fitch downgrade of US rating actually could not mean any big sell-off in the treasury. So that is something. But we should mention that overall, Nifty, along with many other global markets, were hitting a brick wall. And this is just a trigger, kind of a... all right, Nuresh Mirani is here with us. Let's take the discussion forward. Nuresh, what are your charts telling you this afternoon? We've been seeing a kind of a trending day, Nifty, Bank Nifty, broader market. No attempt, even an intraday attempt of a rebound was seen. Do you see this as a sign of near-term weakness?
So the markets had a run one way, and at some point of time, you need to wait for price action to confirm that there is a clear-cut pause. And today's price action tells you there should be a pause in the index. We've broken the recent lows at 19,550 odd levels. And now the next level is 19,200, 250. And overall, the longer term, the last major breakout was 18,600, 18,800. The point is, even if we correct all the way from 20,000 to those levels, it would still not be a 10% correction. It will still be a 5-7% correction, which is a normal case even for a bull market. So the view right now is we've taken a pause on the index. We've taken finally one day, big day on the small cap and the mid cap indices. Over the last, say 10 days, even when the Nifty was correcting, the small cap indices continued to make a new high. So like I discussed in the morning, there was a little bit of a divergence, and this needs a price action confirmation. Today's price action is a confirmation that we are getting into a pause. Whether this goes into a much deeper correction, we'll see over the next 2 days of follow-up. So time to take some stop loss hits across the board in terms of stock specific positions. And then again, wait out for fresh trades, take some short trades or sit on the sides and wait for the next trend reversal.
look at some short positions or sit on the sidelines. That's the view coming in from Naresh. But Kunal, what's your take? You had earlier mentioned that 19,500 is an important marker. There's a sharp spike in the wicks as well. What does it tell you? Is there further weakness or a sharp rebound now?
So Anisha, I have collated some very interesting charts to try and showcase that why 90,500 is important and why this level is important as a change of trend. So this is the start of this entire rally sub 17,000 from March lows for the index. Now every trend has a behavior. So what we have spotted over the last 3-4 months of this price rally is that every time the index comes closer to this moving average, which is the 20-day moving average, we've seen that the correction has halted for the index and we've seen the trend resuming on the upside. So when does the trend change? When the behavior changes for the index. This time around, we've managed to break below that 20-day moving average for the index. Now, assumingly we close at 19,500 mark or below, then we could be confirming that this is the first sign of a change of trend for the index. So for positional traders, this is the first sign of confirmation that we've changed the trend on the index. But does that mean that a bottom gets formed immediately? We look at the next chart, which is India VIX. Again, a classical observation. Over the last 6-7 months of this calendar year, we've seen many a times that India VIX tried to come back towards its 50-day moving average, which is the blue line over here. But it failed to surpass those levels. And whenever that has happened for the India VIX, in the next couple of days, we've seen major panic or more selling pressure, which has come back. So when the India VIX spikes up, we've seen that the index actually forms a further corrective wave. This time around, we have not yet broken that level of 50-day moving average for India VIX, which means that maybe in the next 1 or 2 days, we could see a terminal sell-off for the index. And I think that's what the India VIX is suggesting. But the heartening part for the markets over here is that the indicators have already started to become oversold. So two major indicators which you look out for: put call ratio, both on the Nifty as well as on the Bank Nifty, we have hit 0.45 on the index, which is ideally a case that we have hit extreme oversold in terms of indicators on the sentiment perspective. And the RSI on the early charts is now sub 20. The last time when we were sub 20 was at sub 17,000 for the index, and we've seen what has happened for the index post that.
Very interesting data there. So the oversold position seems to be building up. At least that is what the indicator is telling you, that it's a bit of an oversold zone. But when that terminal bottom is made is the most important thing to watch out for. Just let's quickly take stock of the moves that we had seen in the market with respect to this US downgrade as well in terms of the sovereign rating. Because yes, we are talking about how this might not be very material when it comes to the treasury market, but the last time this drawdown happened was in 2011 when S&P had actually cut down the rating of US from AAA to AA. And at that time itself, we had seen that it had taken 6 months for the markets to recover. In fact, if you look at the maximum drawdown on Dow Jones, it was 19% drawdown from the top. Nasdaq had slipped as much as 20%, and it had taken that particular index 84 sessions to recover those losses. So it's this is what had happened at least last time. And even in terms of the data points, if you can look at what was happening then versus now, not to say that this will be repeated, because obviously it's just a historical data point, but this is what happened back in July 2011. You were saying something, Ajay, to that.
Yeah, I was actually wanting to understand that it will be good to see how many days it took to come back to that level.
That's 84 sessions.
So the peak of pessimism would be interesting to see. In 84 session, suppose a downgrade comes and you fall off the cliff, and the next 3 days the peak point of pessimism is made, then that dip should ideally be bought. Because the next 84 sessions, you are actually making gains every day.
Yeah, so that's interesting. We'll have to take out that data, whether it's the first 20 sessions, 3 sessions, or how many sessions that it took to take for the bottom to get made and then the reversal to happen. We'll try and cut out that data as well. But for now, what we know historically has happened was a drawdown of 20% on the US equities and 84 sessions to recover back. But we have our own markets to deal with, and what is still looking all right has been the IPO market, because we have seen massive subscriptions being made and very solid listings. And one such listing which is lined up to get opened at the end of this week is Concord Biotech. Just to fill our viewers with respect to the business, it's an India-based biopharma company. It's one of the leading global developers and manufacturers of select fermentation-based APIs. They have almost 20% market share by volume as per 2022 data. They have a portfolio of 57 brands and 77 products, and the list really goes on. But let's welcome on board Mr. Ankur Vaid, the joint MD and CEO, as well as Lalit Sethi, the CFO at Concord Biotech, to understand this better. Hi, gentlemen. Good afternoon. Thank you so much for making time and speaking with us. I know it's a very basic question, Ankur, but I just want to begin by understanding the business. Who are your most closest peers? What's the business doing like right now?
Yeah, so very good afternoon. So Concord is into the business of manufacturing, fermentation, and semi-synthetic APIs. And all we do are we do not do any chemical synthesis APIs, and that makes us quite unique. I would say globally there are a handful of companies in this space, and Concord holds a leadership position on many of the molecules that we make. When compared to the peers, I would say that we have built in significant capabilities at our end, because of which we hold such leadership position. And these are that we have a portfolio across a wide range of therapeutic segments, such as the immunosuppressants, oncology, anti-infectives, antifungal. And we have built a very large-scale manufacturing capacities. We have more than 1250 meter cube of fermentation capacity, which would be one of the largest globally for manufacturing small molecule non-penicillin products. And our facilities are approved by all global regulatory agencies like US, Europe, Japan, Korea, which gives our customers the flexibility to launch the product globally with us. So these are some of the capabilities that we have built over the years, because of which we have a leadership position when compared to the peers.
Ankur and Lalit, gentlemen, thanks for your time here on ET Now. The market is abuzz, not only with your offering, but also about the kind of investors you have gathered in your journey. In fact, Ravi was just telling us that in the last 18 years, Ravi Dharamsi, of course, has even tweeted about it, when the late and very respected Mr. Jhunjhunwala also participated in your company some 18 years back. He took stake, and the way company has actually evolved since then, and he only took 15 minutes to decide whether to participate in this journey or not. Talk to us about how, in this last 18 years, how your numbers have grown. I don't want anything forward-looking, but of course, Rare Trust owns 24% stake. But in 2004, what were your numbers like? And now, as we stand, say the previous year, where do the numbers have grown? Just want to understand what has gone into in the last 18 years in making of this company.
Basically, if you look at the historical performance of the company, historically we have been growing at a CAGR of around 18%, starting from 2005, 2008 to till now 2023. With respect to the revenue has grown at a CAGR of around 18%. And with respect to the other parameters, financial parameters, whether it is EBITDA margins or the PAT margins, these are sustainable at the range of around 40-42%.
Okay, so that's the take coming in. As far as the revenue performance is concerned, it's been growing steadily from 600 crores to 700 to 800 crores. Do you think this kind of growth rate is sustainable? And with respect to what is there in terms of pipeline of fresh launches, approvals, etc., could you talk to us about what is lined up?
Yes, so we have built in significant capacities over the last 1 year. Just in July 21, we set up a very new fermentation plant in Gujarat, wherein we have put in 800 meter cubes of fermentation capacity vis-a-vis the 450 meter cube that we have at Unit 1. And just a few months back, that is in June of 23, this new facility was also inspected by US FDA and was successfully concluded with the 0483 observations. So this has been a major milestone for us in terms of getting the Unit 3 at par with the Unit 1 in terms of the regulatory. So we have built in significant capacities, and going forward, this capacity is going to be used for expansion of our existing molecules and also commercialization of the pipeline products. Talking about the pipeline products, we have a very, very strong pipeline of fermentation APIs panning across anti-infectives, antifungal, and oncology, which have a sizable addressable market. And these are some of the products which are there in the generic space, as well as products which are under patent, which we will be going ahead for the launch in the coming years.
Mm-hmm. Lalit, let me come to you. You manage the numbers at Concord, and at least your industry has been facing a bit of headwinds in the last. Nobody's questioning the structural argument of the API and formulation industry here in India and how vital role it is likely to play going forward in overall scheme of things globally. But in the near term, there were some structural, some headwinds which the industry was facing on pricing front, on logistics and raw material availability and all of that. Do you think that's thing of the past, and things will start improving gradually?
Basically, in the fermentation space, the raw material is primarily the agro-based because we are dealing with the microbial cultures. So there we need to, feed them with carbon, oxygen, and maltose kind of products, which are readily, easily available in India. So there, I don't see any kind of a challenge with respect to the availability of raw material or the procurement of raw material. With respect to, let's say, the headwinds which the industry has been facing in the past. Basically, in the last couple of years, we have built up sufficient capacities, and now going forward, the efforts, or you can say the objective of management, is going to be on the consolidation of these capacities. So going forward, also, I don't see any kind of a challenge with respect to capacity utilization, with respect to availability of raw material, or with respect to the pricing. Pricing has always been stable as far as our products are concerned, have been stable for quite some time, for let's say since last 3 to 5 years time. There is not much volatility as far as the pricing is concerned.
And just to add to that, we have always supported our customers in terms of providing the very high quality products at the most competitive pricing, because of which we have been able to gain global leadership positions on the APIs, which is a function of how our customers have gained market share at the formulation level.
Point, and no doubt, I'm just looking at, you have 200 customers, over 70 countries, some of the most marquee names like Intas and Glenmark among them. I want to understand a broad industry view, which you're working with across the spectrum, clients in India and abroad. How does a roadmap look from here on the fermentation related formulations? If we take a 5 to 10 year view, what is the kind of opportunity size are we looking for the industry and for the company?
So, fermentation and biotechnology is a very, very growing field. And, you're seeing a lot of developments happening in this sector, whether we talk about the biosimilars or we talk about the small molecules where currently Concord operates in. And the industry is really a very growing segment. And as one would see that even in India, the government of Gujarat or the government of India is focusing in terms of building the biotech sector and growing that up. So, it's a very growing field. And in this segment, Concord, again, is a leader. We have been building more and more molecules within this sector. The fermentation market, if you see, is close to around $11 billion. And which is a growing field. And, Concord is working towards how we can continue to gain the market share on the kind of products that we are into.
On that note, we let you go. Would have loved to chat more, but the market is not allowing to do that because it's a very, very sharp fall that we are witnessing in the market at this point of time. Though there's a bit of a semblance of a recovery, at least there's no further slide, and we are maintaining that 19,450 mark for now. But from one management to another, we have Anshu Malik, the CEO and MD of Adani Wilmer, as well as Shrikant Kanhare, the CFO at the company, joining us to talk to us about their earnings. The stock is not reacting very profitably to the earnings because this time there has been a slide when it comes to the revenue. As a result, there is a slide in EBITDA, and the profitability has also taken a substantial hit. In fact, a loss for the company is reported. Just wanted to begin by understanding this, Mr. Malik, of what impacted the performance this time around. Is there any one-off, any exceptional that is impacting the profitability?
The good part to note is that there has been 25% increase in volumes. Edible oil has shown very good growth of 27% volume quarter on quarter. We haven't seen such kind of growth in edible oil, particularly branded edible oil. Fortune as a brand has grown faster, and we see such kind of traction because of the prices coming down, and edible oil prices have really come off. So consumers have come back to their preferred brand. On food, we continue to grow at more than 20% for the 8 consecutive quarters. So growth-wise, we are now consistent on our food growth. And today, food business as a volume contributes almost 25% of our edible oil volume. And industry essential also has shown growth of more than 21%. That is mainly because of the oleochemical business, castor oil, and the soya meal, that and rapeseed meal that we export. So overall volume-wise, we are very satisfied. What has happened is that the edible oil prices have come up very sharply, and as we are not able to contra-hedge the local oils, particularly in India, there is no such hedging mechanism. We can only hedge in the BMD and CBOT. So that leaves substantial part of the oil not getting equally hedged. But then these are not a normal phenomena. These are because of the geopolitical nature. You have seen the drought in Argentina, the Ukraine-Russia war continuing, and at times creating a lot of disturbance in supply chains, and then overall monsoon. All this put together impacts the prices, and I think these are not something that we have seen for a long time, and these are unusual issues in agribusiness.
Shrikant, volumes are back, good. What about margins? How are things there on overall margin picture?
See, I think, yes, what Mr. Malik said, we are quite happy, and volume story is quite encouraging for us, and for any FMCG, volume has to go up. And we have been able to grow 25%. On margins, yes, I think your first question was, is it something which is unusual? Yes, this time it was a little bit unusual, because what we saw in this quarter is basically a disalignment of hedges, which we normally do on a foreign exchange, on various exchanges of commodity. They didn't go in tandem with the local markets for a physical trade. And because of this disalignment, what has happened is you had a loss on the hedges, whereas your physical trade didn't give you a compensating gains. So this is a one-time kind of thing which has happened. Usually it doesn't happen, because when you hedge a commodity, ideally when you lose on a hedge, your physical trade should give you a vice versa gain, which has not happened because the exchanges have gone in different direction, whereas the physical trade has gone in different direction in India. So that's the reason why the margin got impacted. But I don't think this should be a usual phenomenon. It's a one-time phenomenon.
One-time phenomenon, and I hope you're not sitting on those high-cost inventories and that you have managed to liquidate. But in terms of the market share, how is that panning out, Mr. Malik?
See, as far as market shares are concerned, wheat, flour business, our market shares have gone up. Rice put together with Kohinoor and Fortune showing slightly up, particularly Kohinoor doing well, because you have seen the traction of Kohinoor coming back, and I'm glad that this quarter end results shows Kohinoor at 3.7% market share alone. So that is a good thing for us. On edible oils, we continue with almost the same margins, same market shares. However, let me tell you, mustard oil have shown a very good growth. And today, not only we are the largest, but by far a very, very clear double the share of any other brands. So that keeps us happy that at least in mustard oil, we have shown how well we can grow.
Mr. Malik, talk to us about distribution. We understand that now rural towns account for almost 30% of your overall volume. And we understand that, it is the smaller towns and even the kasbas and, rural areas where people are moving towards standardization from unorganized to organized. How are you witnessing what phase your business is in? Are you getting tailwinds from this?
See, our growth in rural has been better than urban. Primarily, I would say two reasons. One, our in-depth distribution, which has started paying off. We have a dedicated rural distribution team. And then we have added at least more than 8,000 new towns, that is the rural towns this quarter. So that has given us benefit. Our reach has now increased in the rural market. The consumers have found these edible oil prices comfortable. As a result, the consumption of brands, particularly good brands like Fortune, has increased. So rural markets have done well. Along with this, I would say the e-commerce has also done well. better than the modern trade, because e-commerce, we are seeing very good growth, at least double the growth of modern trade in case of foods and edible oil.
Last question from my side, Shrikant. In terms of the edible oil prices, what is the internal estimate? Because on a year-on-year basis, of course, we've seen a sharp decline. Do you see some sort of stabilization of the global edible oil prices now?
See, the edible oil prices, I think, have been now stabilized. So we have seen a top of $2,000 a ton sometime in May 22 to now less than $1,000 a ton as we speak now. So these prices are more or less stabilized, but there are a lot of geopolitical events which keeps on happening. For example, the Ukraine war, which refused to die down. And these kind of things keep impacting the prices, but I think more or less they will remain in a stable range as we go forward.
And on that note, we'll let you go. Appreciate you joining us on this show. Thank you so much for making time. But what's happening in the market is a bit of a recovery because we are now inching closer to 19,500. We are not completely out of the woods in any case. There's a sharp fall which continues for Nifty Bank, a 700-point slide. All the constituents of Nifty Bank as well as Nifty. Okay, no, for Nifty, there are 3 stocks holding up in the green, but for Bank Nifty, all the constituents are in the red, and the advanced decline ratio is very, very unfavorable.
I would read it as some amount of shorts which were created yesterday, because yesterday also we had a similar trending day. The highest point of the day was made in the first hour. Yesterday, deep in the money shorts of yesterday and today may be covering right now, and that's why you saw some amount of semblance in Bank Nifty, which recovered from 45,750 or thereabout. Kunal will be coming very shortly to talk to us about whether we took intraday support and rebound. Is it covering of those short positions? Pull up Nifty also, and small cap, mid cap, because small cap, mid cap unwinding of HNI trades would also be happening. Nifty did go to almost 19,430 or thereabout and started rebounding. Kunal, can you tell us, is it the short covering which is happening or some technical support levels kind of thing?
So, one of the factors which I was alluding earlier, that the put call ratio in RSI is majorly oversold. So when they are majorly oversold, there is hardly any room for the index to go down further.
So if I'm already running a short position, I would rather...
It's the best time to close it.
Okay.
Best time to close it. Wait out for 150 point bounce on the Nifty. Then create a fresh short for the next leg of downtrend.
So that could be the case. Not out of the wood which you were saying, but covering of the short position. Take a break, come back. More interesting trade talk on the other side. The moment we have a global voice now on the show, there is some amount of support which the indices have actually taken. 19,500 is back. Recovery. Look at good quality stocks are throwing up very good recovery. 5% off days back, Max Healthcare. But still, it's important to just slice and dice the situation right now. Manish Singh is here with us. He's a emerging market specialist and, of course, CIO at Crossbridge. Manish, afternoon, long time. Is it something worrisome which is happening right now? Goldman put out a note, nothing to worry about because of the Fitch ratings downgrade of US. But there are jitters clearly all across, be it India markets or even in your own backyard in Europe.
Yeah, good afternoon. Well, I would say that, I don't think it's a concern. And you have to keep things in context. So when the US debt was downgraded for the first time in 2011, and S&P did the downgrade at that time, it didn't stop the market from rallying because everything is based on a relative basis. So let's look at the developed market. US Q2 GDP growth of 2.4%, Q1 GDP growth of 2%. In Eurozone, which is the other comparative market to the US, GDP growth 0.3%. So on relative basis, there's actually no other market that you can put your money in. So I don't think this is a big problem for the US. The second is that if you look at the report that Fitch had put out last year when they put US on ratings watch, they said what will make them downgrade the US debt. There were 3 conditions they gave. They said significant and sustained rise in debt to GDP. Now that hasn't happened. I mean, debt to GDP is close to 100%, and it may rise because, as you see from the spending demand that the US Treasury is about to make today, it will rise. But it hasn't happened, and you can't say it's sustained rise. The second was deterioration in governance quality. That hasn't happened. The debt ceiling was moved up or suspended until 2025 in a bipartisan way. So government is not bad. The third was macroeconomic policy performance and prospects. I mean, US is growing. You have, as I said, GDP growth is good. Real wages are growing. Inflation is coming down. So where is the macroeconomic policy performance and concern? So I think the timing is I mean, it's questionable that why they did this now. And the other thing to bear in mind, US rating agencies do not have any inside information or other information that you and I have, people in market participants, because they all rely on public data and public knowledge. So based on that, I don't see that concern.
Manish, and it's a lot of times said that these rating agencies look at backward, data and not really what's happening in future. So that might be at play. We also have Jonathan Shizzle joining us on the show. So let me toss this question to him as well. Jonathan, do you think that market was just overheated and looking for an excuse for a correction, and that's what is playing out? Or do you think this could be a bigger worry that market shouldn't just completely rub off?
So yes, I'd agree that markets have done incredibly well. This particular piece of news, which everybody's attributing the sell-off, I'd agree with the other caller that it's somewhat dubious from a timing perspective, but probably it is an excuse to lock in a bit of profit. And obviously, in this part of the world as well, we're sort of fully into the holiday season. Liquidity gets a bit lighter, and markets have done incredibly well. And there are some signals out there that there's a bit of exuberance going on, and certainly the markets will be ripe for a little bit of a correction.
Just yesterday, Citi put out a note that whatever reason might be, but there could be a India versus China trade which could be there in the offing. China starting to look extremely cheap. India may not be that much because of the run-up, and that could trigger near-term FII outflow outside of India. Do you think if that actually plays out or accelerates from here and we go slide further, India becomes a strong buy once again?
I think that's obviously not a new concern. I mean, India has dramatically outperformed China for quite some time now. And it's a factor of India, the Indian market's doing well, and also the Chinese market's doing poorly. With all the issues that are going on in China, be it GDP growth, be it governance issues. I think if you look at flows, you look at generally EM investors, if you are getting, there's only certain investors who do single country EM. A lot of them will just buy the grouping, as little sense that it makes, but some people, most investors do that. And I think, increasingly what we're seeing today is a lot of particularly US investors having issues investing within the Chinese markets as well for various reasons. So I think, yes, there is a risk in the short term of, if you like, more flighty capital that might move out of India to lock in some of those gains. But anything more than, short term, I think India still looks fairly well positioned because of these other factors that are at play that are medium to longer term factors.
So that point is taken. Jonathan, hold that thought. We also have Jay Bala joining us to talk to us about the technicals of the market. Jay, what does it look like on the chart? Like after just going to that 19,400, we have shown a bit of a rebound. Is this level going to sustain, or there's a sharper cut which is lying ahead for us?
The significant support for me was 19,590. It gave way last week, and so the fact that markets went below those levels and where it is now is not a surprise for me. The medium-term thesis that I'm working with since June 30th has been that the market is going to drop back into the previous record high range of about 18,800, 18,700, and then get back to fresh record highs around the Diwali time period or October-November time period. So that's the working thesis for me. And, I differ from a lot of technicians and macro strategists on the dollar index. So that I'll put a note on that. So basically, the dollar index is headed for 110 at least, although my longer-term thesis is it is headed for 120 plus.
Emerging markets like India, if dollar index indeed actually goes to 110 or 120, Jay?
See, the Indian markets did reasonably well in 2022 despite a very strong dollar index. So, we should treat each asset class on their own merit. But at the moment, it does look like the dollar index has brought back a lot of risk assets into inverse correlation. So we'll see what the markets do and take it from there based on further evidence.
You have a very valid point. In fact, if you look at the dollar index last 3-4 days, and Jonathan, I'd like to come to you on that, it is showing signs of strength once again. Last week, Fed actually came out. Mr. Powell said that US may not be heading into a recession. This afternoon, Bank of America, the first one to reverse their call on US economy, saying no chances of recession. And we are already seeing a rally in dollar index. So are we talking about a soft landing there in US, and what did it mean for the rate cycle?
Yeah, so I think that's a very valid point. And, I think the market, it certainly had been rallying more recently. Certainly the equity markets have been rallying on the basis of investors sort of getting more comfortable with that sort of soft landing scenario. It is interesting, though, when you look at some corporate results that we've been seeing off global multinationals, and there are quite a few that are saying, highlighting issues coming out of the US, be it luxury goods companies, we're talking about soft spending in the US. And there's a few other sectors as well that are highlighting definitely a slowdown in the US. But obviously the dollar and the previous comments about US growth remain very valid. And the market certainly seems to be looking for at least probably one more rate rise, but this seems to be going on and on.
Going on and on, but Jay, within the market, which are the pockets that you see are heading towards the oversold territory? Kunal was just telling us that perhaps Nifty itself is showing signs of a bit of an oversold zone. Would you concur with that view? And in terms of the sectors now, anything that stands out for a sharp rebound?
See, I would look at things slightly differently. A strong market doesn't get oversold, and a strong market always gets overbought. So that's the way I look at markets. So if you consider the market oversold, it means there is pending selling post a bounce back. So I wouldn't agree with that thesis. And the sectors which look weak for me is the Nifty Auto, I think, has made a significant reversal. 15,400 was a significant support for me, and it has made a significant high too at about 15,800. So this does look like at least a short-term trend change for me. I would watch the banking index and the Nifty FMCG. If the banking index were to break below 44,500, that'll be a trend change for me. And if the Nifty FMCG index were to break below 51,125, once again, that will be a trend change for me. That will be a trend change, a completion of a trend from the COVID lows for the Nifty FMCG index. And as a side point, when you're talking about banking index, the Indian 10-year yields, I think it's set to harden past the 2022 October highs. And what the 7.15, 7.12 that we saw this week, that's the start of a hardening cycle for the Indian 10-year yields. We're going to see a short-term pullback somewhere close to 7.06 to 7.04, and then there'll be a very sharp hardening of the Indian 10-year yields. That's the thesis I'm working with. So that's going to contribute to the negative impact on the bond holdings of the Indian banks.
Gentlemen, for joining us. Manish, Jonathan, as well as Ajay Balav Cash the Chaos, and cashing the chaos seems to be happening in the market right now because bulls are ready to put up a fight. They're not throwing in the towel right now because there is a swift recovery which is underway in terms of the sectoral indices as well. Whether you look at the IT index, the FMCG index, even the banking index, all of them have seen a bit of a reversal from the lowest point of the trading session, and that of course has come in with the Nifty itself also inching higher. In fact, Divi's Lab is higher by 1.5%. Nestle is perking up quite smartly. Hindustan Unilever is sitting in the green. Asian Paints too. So a lot of defensive buying seems to be happening because the FMCG stocks are now holding out in the green. But time now to take a very short break. Don't go anywhere. We'll track the last 15 minutes of the trading session, and they are pointing out to be very, very, topsy-turvy rides. So don't go anywhere. We'll track the markets when we come back.
So very smart recovery and actual buying on dips or covering of short positions seem to be doing the trick. Look at that last 15 minutes of trade. Deepan Mehta, Director, Elixir Equities, joins us now. Deepan, if indeed this correction or dip would have accelerated, this would have been one of the most anticipated and expected corrections in recent times. Is it not? People are waiting with their buying list because 90% of the people we speak to in the last 2 months were cautious. So obviously, expectation of a correction were high. Were you expecting a dip too?
See, we are in the new phase of a multi-year bull market, and such corrections are to be expected. Timing of it is difficult to figure out, but definitely I think if the market stops to go up, then automatically, you're going to have the weaker hands trying to sell off and book profits, and that is what we are seeing at this point of time. If you scan the entire news flow, there's nothing really negative so as to warrant a correction, but such is the nature of stocks. For no reason they go up or they go down, and this is what is being played out over here. And I do tend to agree with you that the bulls have been waiting for an opportunity like this. Investors who are underweight equity, who could not get money to work in the last few weeks or so, I think they will take this opportunity with both hands, especially the foreign institutional investors. I'm pretty keen to know what the FII numbers are for today evening, because I think they are the biggest bulls in the market at this point of time, and they want to increase their exposure. They have missed out having sold through most of 22 and 23. And now that there's a risk on trade, I think they're coming back at any given opportunity, today being one such opportunity.
Point taken. We have been talking about what's happening at the index level, but let's also look at some of the stocks which are buzzing around in the trading session. You have Star Cements, which is high by a good 10% today. JM Financial is holding up in the green. KEI Industries has seen a good bounce back after the cuts we saw yesterday. 5-star continues to ride the wave. It's 4% higher. Indiabulls Housing Finance maintains the gain of around 5 to 6%. BML, Cyient, Thermax, these are some of the names which are reacting positively, and PVR and AI Engineering also reacting to its earnings. What's not doing well is clearly Redington. That stock is down 10%. And then Marksans Pharma too. There was a supply pressure that was expected today on account of that anchor lock-in opening up. So that stock is down about 5%. And then Piramal Enterprises and some other are also on the back foot, like is the rest of the markets. But the cement pack, that is what I'm going to discuss with you, Dipan, in detail, because of course there's this news flow that Sanghi Industries might be taken over by Ambuja Cement, and that's put a bit of a spike in a lot of these counters. Your view on cement?
See, I think cement numbers have been mixed in the sense that I was pretty pleased with Shree Cement numbers which came through, which were exceptionally good, and ACC also delivered a good set of numbers. But these two companies were the outliers. Broadly, what we are seeing in cement is that volume is very strong, anywhere from high teens to 20% thereabout. But there is pressure on the margins, and that's because of increased competitive intensity, which means that there are the volumes and the cost increases are there, or they may have stabilized, but there is pressure on realization, which is why we are seeing sharp deterioration in the operating profit margins. And I think this is going to be the story of cement for the next several quarters or years, if I may say. There's a massive buildup of capacity taking place within the cement industry, and every company is trying to grow as fast as they can to try and protect their turf. And we are heading into an overcapacity zone. So I'm not that positive when I see a situation like this. I'd like to be neutral to negative underweight as far as cement is concerned. And these kind of price to earnings multiple for the cement stocks are not justified, given that their return ratios are also a lot of under pressure apart from the operating profit margins. So while there'll be good demand, I'm not sure it'll be a profitable demand for the cement stocks.
So almost 400 point on the Bank Nifty and 120 on the Nifty is the kind of recovery we are talking about. Sharad is here with the dealing room chatter and the gossip which is gathering from one of the most influential dealing rooms in the country. Tell us, which is the stock in focus, Sharad, today?
Well, yes, in focus we are having Aarti Farm Labs, and what we are gathering from the dealers is in select HNI counters, buying is being seen for Aarti Pharma Labs. Now, this company itself has been demerged from Aarti Industries and has been listed separately on the exchanges on January 30th this year. Now, of course, the stock is trading below its listing price of 377 rupees per share, and the company itself has the business of CDMO, API and the xanthine derivatives business. Now, the important thing to know is that analysts are stating that the valuations are attractive for the company, trading at roughly 15 times its 12-month forward PE ratio, and also the company will be coming out with a set of first quarterly numbers on August 5. Apart from this, looking at the outlook going ahead, last time the company stated that the ramp up of the new expanded blocks at Tarapur facilities and xanthine derivatives would be a key trigger in the near term, and also they're expecting the EBITDA margins to come in the range between 10 to 15% for FY24. But after that, for the next 2 to 3 years, this number is expected to go between 16 to 17%.
Okay, Sharad, thank you so much for joining us with that take on the company. But for now, the index is showing quite a bit of reversal, just flagging out what's happening across the globe. For now, the Dow futures are down 222 points. The Nasdaq is suggesting a cut of 200 points again. So there's a slide of almost 1%, and the European markets continue to take a knock of around 1.5%. But shifting focus back to our markets, Naresh, any tactical trade that you are seeing in terms of the positioning right now, and also your BTST ideas?
So right now we're playing a little more defensive. So that would be a buy on Power Grid. That's a stock which is corrected from 268 levels to 245, 248 zone. So that's a good area to buy. So expecting a bounce here. The other side is to sell Hindustan Aeronautics, which would be a stop loss at 3750 and a target price of 3600. The stock has seen a reversal on the downside. Power Grid also would be a BTST trade with a stop loss at 244 and a target price of 255.
What about you, the BTST trade?
So two sell calls, and specifically the stocks which have broken below their 200-day moving averages, which is a rare case in this kind of a market. So the first one is GNFC. Would suggest a sell with a target of 560, stop loss at 592. And Industar is the other stock which has broken below that 168.69 mark. So that's also a sell, targets of 162 and stop loss at 173.
Deepan, look at how some of the IT stocks have rebounded today. Pull up Tech Mahindra, because you know the low the Tech Mahindra stock actually made on the result just a while back, that low is not being violated. It was around 10,000. 1,080 or thereabouts, 70-80 bucks. It has rebound from there. A lot of big new joinees are happening there. There's a management change. The stock is almost broken into the green. Would you be buyer of IT stocks in this decline, which is something already bombed out quite a lot, or maybe chemicals, another bombed out area, if it falls further from here?
No, not really. I think when I see the entire spectrum of sectors and industries which are in play, we do feel that the scope for making a decent return is better in the domestic focused companies. And we have excellent industry trends in a whole host of domestic focused companies like banking, capital goods, auto ancillary, industrial, real estate, hospitality. There are so many sectors which are inward oriented, which are focused on rising domestic spends, or because of a capex cycle picking up, or because of a cyclical industry starting to do well. So we'd like to prefer and skew our portfolio towards those sectors rather than the export oriented sectors, or where the pricing is dependent upon international prices, because there's still a lot of uncertainty as to how that would really play out. And while you may get good bargains within the export oriented sectors, could be software, could be chemicals or related or similar type of businesses, but the risk return profile is not in your favor, nor are the chances of making a decent return. So from that point of view, we want to be neutral to underweight software. Same goes with chemicals, same goes with most export oriented sectors. It's just a comparative analysis, when you feel that you have got so much of certainty, visibility, and such good news and numbers coming through from domestic-oriented businesses, why do you want to look at export-oriented businesses at this point of time? And if you look at the GST figure which has come through, I think the only dampener in the GST is the GST on exports. So I think that gives an indication to us as to where we should be placing our bets in a market like this.
Relative basis, of course, the domestic-facing industries are looking better than export-facing. Naresh, your view on a couple of these counters which are bouncing back? Max Healthcare is the one that we were pointing out, a recovery of 5% from the lows. And Zomato, the earnings are tomorrow. Ahead of that, any sort of trade there?
So Max Healthcare just saw a dip during the day, but it is back closer to the same prices where it was yesterday. So no trade out here. It's been a slow and steady trend. Would not be looking at it as a trading idea, but the trend on the longer term still remains positive. So again, a buy on dips to 550 to 530 levels going forward as well. Zomato is something would wait for the results. The stock has already moved up quite a bit over the last few months, but the trend is still positive. You want to be buying on a dip closer to 80 to 75 zones. So any dip due to some result reaction could be an interesting time to get in.
So just taking the cue to ask Kunal the question as far as cement is concerned. Star Cement, Prison Johnson, and of course Sanghi Industries, which is in focus on account of the probable deal.
Well, I would believe that not too many cement stocks are actually showing a major bounce. In fact, if I talk of the larger cap names, frankly, there is hardly any materialistic bounce which has happened to these large cap stocks, whether it's Shree Cement, Ultratech, even the likes of Dalmia Bharat and India Cement, etc. They've shown a very feeble or a shallow bounce, and that generally is a precursor of more selling which could come back into these names. Yes, there have been few exceptions in the mid-cap space, the likes of Sanghi, for example. The stock has broken past about the 78 barrier, then 90 plus levels. I think today the stock hit 99 plus mark for itself, the last I had seen. So that's an exceptional chart. But when I look at the entire pack, most of the stocks, large cap names in the cement pack have been underperforming. So I would not be too much keen into buying the sector as well as stocks from the entire pack.
Dipan, what is that buying list that you have kept ready for this down cycle?
See, as I said earlier in your show that, we are seeing very good traction in the banking NBFC space. The winners so far in this earning season from the bank side, I think, again, disclosure, we and our clients are invested, is IDFC First Bank, I think, came with very, very decent set of numbers, well beyond their peer group. Within the auto industry, I think Maruti came with a very good set of numbers, and we are looking forward to numbers coming through from Eicher Motors. In the capital goods space, we liked Praj Industries as well as Larsen & Toubro. Excellent build-up as far as order book position is concerned. And so on and so forth. I think broadly, as I said, that, we are focused more on the domestic companies per se. And these are the sort of picks that we like to go for broadly.
Sure.
And looking forward to good numbers coming through from other domestic focus sectors as well.
Sure, okay, domestic focus, we understand that, and financials. These are the two top bets. 50 seconds for the